What's going on, Investomaniacs? Knight Rider here, and today we're taking a look at the top 10 dividend growth stocks of 2019. By the way, we're talking not about the growth of the dividend itself, but growth stocks that also pay dividends. Up first at number 10, we've got Nvidia with its 0.41% dividend and 21% revenue growth in 2018. Nvidia's past couple quarters have been rough, with its most recent quarter shrinking revenues by 24%. It was bound to happen. $100 billion companies don't sustain growth rates of 40%. You had some warning to get out of this stock, knowing that cryptocurrency trends were coming to an abrupt halt, and that would negatively impact Nvidia's sales to some extent. With Nvidia's stock now down 47% from its highs in October of 2018, a lot of the risk has been taken out. Even though with its subpar Q4 2019 report, the stock actually didn't react that badly. That's when you know most of the sellers are out. This is a risky stock, but I think the risk reward looks good at these levels. Up next at number 9, we've got It's the Way the Dreams Come True. We've got Disney. That's my hometown company right there, living in Orlando. They own this city. How many companies you know that built a city like Disney? Come on, guys. It's got 1.54% dividend and 8% revenue growth in 2018. It is the least amount of revenue growth that we have on this list, but it's a great company, which is why I'm still including it. It's a relatively safe growth that you are seeing. Disney is a true conglomerate with the ABC channels, Disney Channel, A&E Network, ESPN, Legacy Disney Movies, Pixar, Marvel Studios, and Lucasfilms. Plus, what most people overlook are the amusement parks that I get to enjoy so much as a resident of Orlando. The resorts, the amusement parks, the cruise line, which account for 34% of revenues, and it's not really discussed that much. In March 2019, Disney is set to acquire 21st Century Fox. This will also give Disney a 60% ownership stake in Hulu, which I love. I love the future prospects of Hulu. Disney is also in talks with Warner Media to acquire their 10% stake in Hulu, which if it goes down would then give Disney 70% of Hulu. Disney is also one of the strongest companies in the world when it comes to merchandising. All the money's in merchandising and of course licensing. If you're looking for a safe dividend, a safe place to put your money and sleep well at night, but you still want a reasonable amount of growth, Disney is always a good bet. Up at number 8, we've got Costco with a 1.04% dividend and 10% revenue growth in 2018. One of the signs of a great company is when it can raise prices and customers hardly flinch, which is exactly what happened when Costco recently raised annual membership fees. And nobody really noticed. They're like, yeah, we still need our Costco, which is exactly what happened with me too. I'm like, I still need my Costco, man. Where else am I going to get wild-caught Alaskan sockeye salmon for $13 a pound? Let me tell you, nowhere. It's $20 at Walmart, and that's supposed to be a cheap place. So I'm like, okay, I'll pay a little bit more if I can get, and like the cage-free eggs, oh, they have so much stuff. Spinach, I get a lot of stuff there. I just wish it wasn't so dang far away. That's the only bad part. I got to drive so far to get there. Costco's strategy is different from other retailers like Walmart or Target. They make most of their money from the membership fees and sell a lot of their stuff at close to cost. That makes you feel really good if you're a person like me. You're like, oh yeah, I got me a deal. I got me a deal. Plus, the way that Costco does their stuff, while you go to Walmart or Target and they got like every brand under the sun, Costco, they only have 1 or 2 brands for most of their products, which means if you are one of those brands, you're virtually guaranteed a massive amount of sales because there's not really any other options for the consumers to buy. So it's a bunch of sales, and that gives Costco really great negotiating power for low prices, which they can then pass on to their customers. Plus, it doesn't hurt that Costco is one of Charlie Munger's favorite businesses. Up next at number 7, we've got Visa with its 0.67% dividend and 12% revenue growth in 2018, as well as 12% revenue growth annualized over the past 5 years. Earnings per share grew 57% in 2018. Dang! That just sounds like a lot, doesn't it? 57%. In 2018, Visa had 3.3 billion cards that were used at 54 million locations to process $11.2 trillion of transactions. Holy smokes, those are some big numbers, aren't they? Visa has roughly half of all credit card and debit card transactions, meaning unlike American Express and Discover, merchants practically have to accept Visa. Although Visa's dividend is somewhat small, they have been growing it at 20% per year over the past 5 years. Up next at number 6, we've got Starbucks, the ladies' favorite place to go spend $6 a day, with its 2.03% dividend and 10% revenue growth in 2018. With 14,600 domestic locations and an extremely loyal base of customers, I feel like they're mostly female, but I don't really ever hear dudes that go, dude, I gotta get my Starbucks, man. But like every woman, right, in the entire United States, like, oh, I got Starbucks. Starbucks is not going anywhere anytime soon. And that means you have a stable dividend you can count on. But where's that growth coming from? As Donald Trump would say, China. I love China. China loves me. Starbucks grew locations at China by 18% in 2018, and they're going to see years of double-digit growth ahead in China. In China and the Asia-Pacific region, Starbucks opened over 1,000 new stores in 2018. In 2019, Starbucks projects to open 2,100 net new stores globally, including roughly 600 in the Americas and 1,100 in the China and Asia Pacific region. Up next at number 5, we've got Domino's Pizza with its 1.04% dividend and 23% revenue growth in 2018. Thanks to strong growth, this stock gave you a 32% gain in 2018. Earnings per share have grown 24% annually over the past 5 years. The dividend has grown at 22% annually over the past 5 years as well. Domino's is the technology-friendly pizza company. Back before Grubhub and Uber Eats was a thing, Domino's was streamlining their online ordering process right through their app. Without ever having to talk to like a human being on the phone, right? Kids don't want to do that. My generation, and that's true. I don't want to call someone like, I just want to click a button on an app and I want to get my food, and that is exactly what Domino's does. Up next, number 4, we've got Microsoft with its 1.64% dividend and 23% revenue growth in 2018. Whew! Microsoft CEO Satya Nadella has done wonders for Microsoft shareholders in the roughly 5 years since Nadella has become CEO. Microsoft stock has tripled as Nadella has focused on moving Office to a subscription-based service with Office 365, growing Microsoft Azure, which is now a solid number 2 competitor in cloud infrastructure behind Amazon Web Services, of course. Microsoft's acquisition of LinkedIn in 2016 has proven to be a successful one, with last quarter's year-over-year revenue growth of 29% for LinkedIn. Good job, guys. With a dividend payout ratio of under 40%, it's a safe dividend while still providing Microsoft a solid chunk of cash to grow their business. Up next at number 3, we've got Broadcom with its 3.89% dividend and 18.21% revenue growth in 2018. When it comes to high dividend stocks with solid growth, Broadcom is in a league of its own. You'll be hard-pressed to find other companies with a 3-year annualized growth rate of 45% that also pays a nearly 4% dividend. So why isn't this stock number 1 on this list? Simple. It's risky. Broadcom is not attaining that growth organically. They're buying it. They're buying it through acquisitions. Since 2013, Broadcom has acquired roughly $70 billion worth of companies. Broadcom has nearly $38 billion in goodwill and intangible assets, as well as $17.5 billion in long-term debt. That type of growth is risky, but when it works wonders. And the shareholders have been well compensated over the past several years. Up next at number 2, we've got Visa's little brother, MasterCard, with a 0.58% dividend and 20% revenue growth in 2018. MasterCard, it's like Visa, but it's better, at least when it comes to an investment. Going forward, it's got better future growth prospects. While Visa is a massive $328 billion market cap company, MasterCard sits at $233 billion, yet is also accepted nearly everywhere Visa is. While again, American Express and Discover are only accepted at certain locations, practically everywhere has to accept Visa and MasterCard. While the bottom line looks better on Visa, as it is a larger and more established company, MasterCard is growing revenues quicker and is likely to close the earnings gap with Visa over the coming years. I like both Visa and MasterCard, but if I had to choose one, it'd be MasterCard. Up next at number 1, we've got Apple. Look at that stupid original logo with its 1.6% dividend and 16% revenue growth in 2018. Apple may no longer be the growth stock it once was, but when it comes to valuation relative to growth, you can't get too much better than Apple. Yes, iPhone sales have recently gone down, but you have to ask yourself, is that the end of Apple? Is it the doomsday for Apple, or is it a hiccup? When I think out 10, 20 years down the road, I see Apple still being a dominant player and generating massive amounts of profits just like they are today. I believe iPhone sales will continue to grow long term, but I'm even more excited about Apple's service stream. That's the App Store, iCloud, and Apple Pay. These areas are still growing revenues at a over 20% clip, and likely carry higher margins relative to the iPhone. With a dividend payout ratio of roughly 25% and a strong balance sheet, you can sleep tight knowing your dividend is safe. Plus, Apple is now Berkshire Hathaway's largest holding, so that's got to say something. While Apple may not be the fastest growing stock going forward, it is certainly one of the safer investments on this list, at least long term, which is why it's number 1. So there you go, guys. Investomania's top 10 dividend growth stocks for 2019. Hope you guys have an awesome day.